Well, welcome everyone to today's webinar titled From Uncertainty to Confidence, Trade Policy's Impact on Business Strategy. This is Brian from Strategic Treasurer, and we're pleased you could join us as we consider how organizations can adapt in response to the shifting economic landscape. Our speakers for today are Dory Malouf, Director of Value Engineering North America at Kyriba, Lisa Husken, Value Engineer at Kyriba, and Craig Jeffery, Founder and Managing Partner of Strategic Treasurer. Welcome, Dory, Lisa, and Craig. And I'll now turn the presentation over to you.
Thank you so much, Brian. Lisa and Dory, it's good to present with you guys.
Likewise, thank you for the opportunity.
Yeah, Dory, your sound is not coming through. If you just want to check on that, that would be great.
Is it better now?
It's perfect now. Excellent.
Yeah, I am joining you from all the way from London.
Awesome. It's great how technology allows us all to connect. And thank you, everyone, for being part of today's webinar. There's a lot of good content, and we'll give you a quick overview, and then we'll jump into that content. So again, thanks for joining. What are the topics that we're going to cover? We're going to review briefly the current situation and where those pressures lie, where they sit, how they're impacting organizations. So changes going on, there's volatility, and some companies are impacted more severely than others, but there's certainly I call it a reasonable amount. It's not a period of calm. It's not a period of great pressure like certain periods, but it's certainly the water is choppy. Then we'll move over to volatility across some differing measures. So we'll look at tariff activity, interest rate changes or holding steady by different central banks. And we'll look at FX shifts, and lately we've seen a little bit of a weakening of the dollar. Then we'll move to the impact. This will be about actions, plans, cash level, how there can be volatility, and that triggers Treasury and Finance Group to make changes. Then for the tactics and strategies, how do we manage the uncertainty? We'll look a little bit about look to visibility, accessing capital, technology, and things that help us to become adaptable as organizations and as finance partners to organizations. On the key takeaways, we'll cover that at the end, but it's about technology, data, and mindset. That's our agenda, and let's get into it. So I'm going to flip to our first slide about the current situation, today's uncertainty. I think I said before, it's like sometimes you have a period of panic, there's wars, there's a global shutdown due to pandemics, or there's a giant crisis. Other times it's extremely stable. We're somewhere in the middle, right? It's become a period of volatility, some uncertainty, and the impacts are felt differently. And so to open it up, maybe Dory, I'll kick it over to you, and Lisa, you can jump in as well, maybe to talk through what everyone's experiencing, maybe in different measures than each other.
Yeah, Craig, thank you. And hello, everyone out there. Hope everybody is safe, happy, and well today. One of the things that has been interesting about this time period, in particular, if you're in the world of Treasury or in world of finance in general, volatility has been here really since 2020. It has not stopped. Like, it started with COVID, and it wasn't COVID anymore. And then it was wars. And if it wasn't wars, it was geopolitical. And if it wasn't geopolitical, it was tariffs. And all these things just don't seem like they want to end anytime soon. Even now, here in North America, we're headed, looks like, for an impending government shutdown. And all that volatility impacts so many things in terms of the decisions that are made day in and day out, in particular for companies who rely on, for example, government subsidies or do business with the government, or multinational companies who have operations overseas or manufacturing overseas. For example, the pharmaceutical industry just last week now has 100% tariff on medicine coming in from overseas. The Hollywood industry, the movie industry now has additional tariffs as well on movies made outside of the United States. All of that volatility is impacting the supply chain. It's making organizations reconsider how they source their supply chain and how they solidify their supply chain. But more importantly, they're asking themselves, how do I make up for that hole that was just blown up in my P&L? Where am I going to find the sources to offset some of those expenses? And one of the things that they're playing with that's easy outside of overhead, we're starting to see unemployment kind of rise steadily a little bit here. But one of the things that they're playing with to try to mitigate some of those costs is liquidity and capital structure and working capital management. Another area is being more strategic in how they manage their currencies and exposure in currency to try to mitigate any balance sheet impact or income statement impact. And really, we've been in this environment since 2020. It doesn't seem like it's stopping anytime soon. Lisa, what do you think?
Great intro, and nice to meet everybody. I think Dory also, with that uncertainty, is a lot more, a lot of new opportunities and new challenges being brought to the Treasury team and the finance team. A lot of us treasurers and former Treasury practitioner here, when you had something that was a lot more stable, it was kind of a little bit more, it was a little easier to forecast and a little easier to predict. And now with all of this, the tariff volatility, geopolitical, the supply chains, yes, it's been, happening over the course of the last 5 years. But I think what's happening really is the demands from the CFO and from the C-suite, down to the finance team, the treasury team, really looking for them to provide some strategic insights for them to be able to ensure that they have that financial resiliency. And I think that's really where, a lot of our treasury teams today are feeling that added pressure.
Yeah, a lot of that information is due yesterday, right?
Of course.
Right. Can't wait for it to get to my desk a couple days from now. I can't wait for it to get to my desk next week. I need that information as quickly and as reliably as possible.
Yeah, great points. Yeah, the implications on the cash and liquidity side. How's that changing exposures? Is greater volatility increasing the level that the level of risk that you're seeing, as well as, hey, can we forecast better? If we're trying to get information from the past really quickly, we also want to know what the road looks like ahead. Tariffs are one of the items maybe only recently surpassed by the partial global government shutdown in the U.S. Maybe Lisa, you can kick us off and talk through this point.
Absolutely, thanks, Craig. So, I don't think it's a secret that we've seen a dramatic escalation in tariffs over the past, I'll say, year or so. As you can see on the graph here, if we look back to October 2024, it was an estimated $611 billion in goods that were impacted by tariffs. If you fast forward just 7 months, so to this year, May of this year, that number skyrockets to about 4 times, looking at almost $2.4 trillion in goods that are being impacted by tariffs. So just to put that into a little bit of perspective, that equates to about 69% of U.S. Goods imports, or about 9% of the total U.S. economy. So from a U.S. tariff perspective, these trade barriers are not just numbers. They translate into real cost pressures for companies that are involved in importing goods. I'm located here in the Metro Detroit area, so a lot of our industries and a lot of the key industries, manufacturing, automotive, steel and aluminum, construction, these are all very heavily impacted because of their reliance on international inputs and really on the raw materials. And we have more on the way. As Dory mentioned, today, I believe, was the effective 100% of that tariff on brand name or patented pharmaceuticals. Later this month, additional tariffs are going to be coming through for softwood lumber, cabinets, vanities, wooden furniture. These are all set to go into effect sometime in mid-October. And really, this unprecedented, I'll call it, tariff activity is marking a pivotal shift from, as we kind of saw, some of the relative stability. You see that little peak around 2019, but we've seen things relatively stable. And now with this unprecedented activity, we're really having more pressure on the US corporations, on finance teams to respond to this environment with enhanced liquidity management and really making sure that we have access to the working capital lines, and really helping to articulate and factor in the potential impact of the tariffs into your cash flow forecasting model. And I think that's where a lot of organizations are kind of hindered if you don't have the right tools to provide some of that advanced scenario modeling, because that's really critical to be able to model the tariff impact really across multiple different dimensions, right? You have to take into account the impact on the cost of goods sold. What is the impact on the pricing strategies going to be? What's the impact on hedging either your currencies or perhaps commodity risks? And I think what we're seeing is really, it's a resulting pressing need for this cross-functional collaboration. Rather than just having treasury being operated and making some of these strategic decisions in a silo, we really need to collaborate with our procurement teams, with the supply chain teams, to make sure that we're optimizing your decisions around things such as inventory management, supplier selection. And I think it's really a wake-up call for companies to ensure that they're elevating their trade risk management to be able to be more proactive, to adapt some new strategies to ensure that resilience. Dory, do you have any other comments or insights?
Yeah, I mean, you nailed it in terms of the strategies that are deploying. One of the things that I've been thinking about is at what point, because for the most part, not entirely, for the most part, companies have been doing a pretty good job eating the cost. We just started to see over the last couple of months, and this is, in my opinion, going to be the story the remainder of the year, is how much more can they absorb? And not only how much more can they absorb, if they can't absorb it, which that will happen, where is it going to hit? We have seen, you said we're in the Metro Detroit area, I am as well, and we have seen auto prices go through the roof. Each car is at least $2,000 to $3,000 more now. In addition to that, we've seen grocery prices still elevated. Inflation came in at about 2.9%, 2.7 all in, but that's still above the Fed's target of 2%. So I think the storyline for the rest of the year, in addition to the internal collaboration, in addition to trying to make sure they're very tight with how they manage the information and how they position their strategy when it comes to the supply chain, how they manage the currency and liquidity, is at what point does, for lack of a better word, does the bottom fall out, right? At what point does it turn into, we've plugged as many holes as we can, and this hole is just too big to plug, and we got to find a way to make sure that we recoup some of this cost somehow. That to me is interesting, and I'm curious, Craig, what are your thoughts on that one?
Yeah, I think that's a good question, because there's a couple things. Is the tariff impact is one aspect? Is that muted? It's 8 to 9% of our total economy. And if it's a 10% increase, that's less than 1%. That seems fairly muted, and it can be a one-time price shift. Those are all the things that make it seem muted. But what doesn't make it seem muted is, and some of the other ones are, what's elevated is your situation may be 45% or 50% of your production now, and let's say it's 30%. So now you're talking 15%. Your margins may not be 15%.
Exactly.
And so those are some areas where calibration, depending on where you are. I think the other part is just before tariffs hits, there's a little pull forward of ordering. And that's where you see some of the ability to adapt to the new situation. Well, if it runs over that time frame, we've seen the administration shift some of those tariffs back down when they've gone, let's just say, very extreme, trying to negotiate the deal. But that's not necessarily something that you can rely on. So there's a couple elements that make you say, hey, the sky's not falling. Other things saying it's getting pretty close and pretty tight. So I think the idea of we need to be wary, we need to be mindful. And you mentioned something about pricing. Maybe it was you, Dory, or Lisa. You go to the grocery store. Well, we had a period of 20 to 25% increase in our food prices. Now, even if it's in the range of 2 to 3% or whatever it is on the food side, that's on an elevated level. So it certainly feels very different from what things used to be. Pre
Yeah.
the inflation hit.
Yeah, and that's a great point on the planning on the company side. And when I spoke to a shipping company, I'm not going to say the name, and this was about a month ago on the pull ahead stuff. And what they told me is right now, some, not all, some of the organizations they do shipping for are saying hold everything at the port. Don't bring it in unless we absolutely need it because of the pull aheads, number one. And number two, they're having a difficult time in this company planning. And I can imagine that that's probably the case for some of our audiences listening today is most companies don't plan for 90 days, right? They plan for the year. They plan for 2 years, 3 years, 4 years. And whatever the scenario is going to be as these deals are negotiated, you still don't know what that's going to look like and if it's going to be negotiated or if it's going to be finalized. Remember, there was a deal with China about 2 months ago. It was supposed to be finalized by now. It's not, right? Same thing with Mexico. It was supposed to be finalized by now, but it's not. So those things are still in place until they're finalized and voted on and certified by both parties. So it's difficult. It's very difficult to plan. And I think that's the story for the rest of the year is what's it going to look like and when does the bottom fall out? And if it does fall out, how long will it fall out for? Until some things kind of get um, emergencies put in place to try to finalize these deals so that organizations have a more stable outlook on what to plan for.
I like what you said. I didn't like using the words bottom falling out, but I understand. I understand. There's certainly some movement there. A lot of good discussion. I think we could go on more. Here's our first poll question. So everybody pay attention to what you see. If you can't see the poll, look in the chat box. Brian has helpfully laid out how to pull it up. How significantly are you shifting trade policies? How significantly are shifting trade policies and tariffs impacting your organization's current business strategy? So this is really calibrated to you. Is it very significantly, somewhat significantly, minimally, not at all, or unsure? And this will let us see how diverse the group is from a standpoint there. And after you hit that and hit submit, look in the chat box. Follow Kyriba on LinkedIn. Follow Strategic Treasurer on LinkedIn. That would be excellent. And I'll give everybody another moment to type the response.
I'm really curious to see where this is going to land.
So if we have, I see people already jumping the gun and typing in Kyriba, which is awesome. Go ahead and type in. If we get 80 people typing Kyriba, we will share all the poll responses with you in the midst of this deck when we send it out to you. So that's just something we do for fun. All right. So what do we have? Okay. It's somewhat significantly.
I mean, if you look at it, that's a good, that's a good percentage between very and somewhat. That's almost half the people that are on this call.
Almost half, yeah.
Yeah, so the bell-shaped curve, it's heavier on the minimally, 28 to 16 on the very, and somewhat is 35. So it's pretty much sitting there on the somewhat significantly, maybe a little bit towards the minimal, but that's you're over 50% on somewhat or very, and on the minimum side. So it's people are paying attention on this webinar, which is good. Thanks for
Maybe it is the bottom falling out.
I would say the bottom falling out would be like 50% on very, 40%, and then other people, because some companies are really not impacted other than by amplification. But this is really good. Thank you for sharing all of that. That's awesome. And let's jump into the economic environment. I think, Dory, you're going to take us through both interest rates by central banks, inflation, and some currency activity.
Yeah, so on the interest rate front, obviously we had our first cut. And what's keeping the Fed in check, and they're in a very peculiar position, because if you look at the inflation, it was really headed down until about May. And then it started to like kind of hover there or tick slightly up until about May, or, Liberation Day. When you look at that, that puts the Fed in a very different position because they have a dual mandate, right? Employment and interest rates. If employment is starting to tick up and inflation is hovering and also ticking up, people are calling for more cuts, and there will have to be more cuts because employment is key, obviously, to any economy. And the predictions are for 2 more cuts, but I think it hovers around what happens over the next 2 inflation reports that we will get for October and November. That will really tell us about what's going to happen for the rest of the year. Actually, even the September number is going to be due even before that. That's going to be interesting to see how the Fed responds, because some forecasts put inflation at 3.5 to 3.2% at the end of the year. Some are putting it at 2.8, 2.9%. That's still, in any scenario, whether it's above 3 or slightly above 2.5, it's still above their 2% target. Unemployment, some are putting it at 4.5 to 4.7%. That's still higher than where it is today. So that's a very tough spot for the Fed, and a lot of pressure to make sure that they manage this in a very strategic way, surgical, really, more than strategic, to make sure that we don't have that bottom falling out on the economy, and have it be more, again, we say the word soft landing like we had during COVID.
Excellent. So the U.S. Fed dropped rates 25 basis points. The Bank of England held steady the last time. So a little mixed environment out there for central banks. Shifting over to currency, what can you tell us about that?
Well, currency is interesting, in particular in what's happening with the dollar. One of the things that we've noticed with the customers that we work with is they're taking on shorter tenors so that they don't hold as much on their balance sheet or have as much volatility on their P&L, given the volatility that is tied to geopolitics. There's a lot going on, again, instability since really 2020. And those scenarios, when you add tariffs to it, are impacting the value of the US dollar. It had a good run of strength for about 3 to 4 years. And now it's getting back to its historical trend of being lower in value. That's good for manufacturers in the US, but it's not good for the dollar and the viability when it comes to the Fed and our balance sheets as a whole. So when you look at it, as long as there's still that volatility, what we're seeing is companies leveraging tools that help them synthesize the data, cleanse the data, and make sure that whatever exposures they have is the right amount to hedge or position in terms of a short type contract versus going very heavy 6-month, maybe 9-month type tenors. We're seeing more of the 3 months at this point to try to just see what's going to happen and when is there going to be stability when it comes to currencies.
Yeah, excellent. Excellent information. Lisa, any thoughts on this before we slide over?
No, my only other kind of thought with regards to, as Dory mentioned, this shorter tenure is the supply chain impact of that as well. So if organizations are looking to potentially diversify their supply chains, that may also be contributing to, you know, that shorter hold, because they're looking for other opportunities to kind of reduce their currency risk exposure.
Yeah. And I think the USD, the dollar sterling chart appears to be inverted to me as I look at that. But we'll get the right one sent out when we send it. I'm like, wait a second, that's not how it is. Of course, we don't see that on the run throughs. We see it when we're live. So there you go. That's another great thing. So what's the impact of volatility? I'll start and then kick it over to Lisa and Dory. So how is this having an impact? We already talked about some of that. What's going on with the tariffs? That impacts cost of goods sold. There's the, maybe we need more inventory if we're doing this pull forward. Where do you have the ability as companies to prices and adapt your prices to the ongoing shifts in the elements that go into your goods or services? So sometimes the whole eating in the beginning worked well, and when you run out of the room, then the pricing has to stick. So how will that have an impact? That tied into Corey's, he used the term bottom falling out. That's when do you get to the edge of your ability to flex, and then more dramatic changes happen, more one-time or systematic changes have to occur. And then central bank policy and FX rate. I'd love for the two of you to jump in on this discussion.
Absolutely. So if we're talking about along the lines of central bank policy, I know we were just talking about, are there going to be additional Fed cuts for the coming year? Hopefully, or it's anticipated that there will be 2 of them. But I think more importantly, it's how that's impacting U.S. corporations. So Kyriba puts out a liquidity performance index report semi-annually. And what we've seen is a lot of debt that was taken out in 2020 at almost near zero or percent interest rates. That's all coming due now. Those were kind of like 5-year term loans that organizations had relied on to help navigate that type of uncertainty. And what we're seeing now is U.S. organizations are really faced with decisioning on how they're going to manage that debt and really the impact that it's going to have. So the 0.25% decrease that the Fed just released was definitely welcomed by U.S. corporations that are needing to either pay back the debt or refinance it. But it'll be curious to see how they are managing with the potential for some of these, for some additional rate cuts. I think we've seen a little bit more of a shorter term debts covenants to take on in hopes that they'll be able to experience that other 0.25% or 0.5% cut later on in the year.
I think one of the things we're seeing and focus on as well, Craig, is on the cash conversion aspect. Cash conversion helps you navigate a lot of these issues. As always, in any scenario, cash is always king. You want to hold on to it as long as possible, and you want to get it in the door as quick as possible. So we're seeing a lot more interest, in particular in North America. Historically, this has been a very European-centric type play in working capital management, leveraging factoring, receivables financing, supply chain financing on the AP side. So all of those things are means that are available to companies in their toolbox to help mitigate anything that happens when it comes to economic slowdown or things like government shutdown, slowing on the receivable side. If you're an entity that does a lot of business with government, having that cash flow certainty, accelerating it in the door is going to help you maintain resiliency in any of these scenarios. The same goes with the payable side. What you're doing when you have a program on the payable side is you're solidifying what we've been talking about earlier, is that your supply base. Sometimes that supply base can get distressed. If you're helping them solidify their cash flows with a supply chain financing program, they may take a little bit of a hit to participate on it, but they're solidifying their cash flows at a much better rate than they can going out to market with their own bank relationships, leveraging your financing arm in the program. So those are ways to manage the tariff and bank issue. We touched earlier on how central bank, how they manage the FX scenarios. I am really looking forward to having this discussion with you, Craig, next here in December. You and I are doing this on what we're thinking about for 2026. What are the hot topics for 2026? I think AI is going to be huge for Treasury next year. The reason I think AI is going to be huge for the Treasury organization next year is because data has always been the problem when it comes to forecasting, whether it's on currency volatility and positioning your strategy on currency, or whether it's on just your simple cash forecast. It's like the Holy Grail. Nobody seems to have figured it out yet. I think AI is going to help that a lot. And in those scenarios, I think that's one of the tools that's going to be available that isn't entirely available today or hasn't been dabbled into by Treasury organizations as much as it should be in these areas to help them do that data integrity check and eliminate the garbage in, garbage out aspect that really, even before COVID, this has been a problem for Treasury in trying to manage what they need to do on the FX side and what they need to position on the capital markets side. I think AI is going to help that a lot, and that will be a huge cost reduction for companies as well, not just on the overhead side when it comes to people, but it also going to be a big impact on currency and better management of capital.
Yeah, I guess I'd say two things. One, I was both surprised and delighted that you brought that up and fed it into volatility. I would not have expected that, and yet it makes good sense on how we manage that volatility. So I too am looking forward to the December discussion. Lisa, anything that you want to jump in on here before we move on?
No, I think Dory touched on everything else.
Perfect. Okay. So everyone was waiting for the second poll question, and here it is. This is a select all that apply. You get to pick more than one. Our risk management posture is best described as we take positions on interest rate changes, take positions on FX changes. We hedge to make money at times. We hedge to bring our exposures in line with our risk appetite. We accept various risks, but monitor and adjust expectations. We believe hedging adds cost to our business process and never or rarely hedge. We monitor or manage risk carefully or other unsure. This is probably one of the most complex questions we've asked in a poll. So take your time and tick them off as carefully as you can. We'll give everybody a little bit of time for that.
I'm curious as to the responses to this one, just given kind of the unprecedented nature of the uncertainty that we were just talking about.
Yeah.
Trying to put myself back in that chair and see how I would vote, Lisa.
I know.
Presenters are not able to vote.
No. But I'm really interested to see what the results are. I have an idea, but let's see where it comes in.
Yeah,
So,
I've got 2 or 3 in my head.
Yeah. We have when you're done, when you submitted them, go ahead and look in the chat box. I'm told we need 31 more Kyribas to make it so we can share all the results. So encourage you to type it. Kyriba spelled Kyriba. There you go. Capitals, lowercase, all uppercase, doesn't matter. If it's close, even if it looks like Keurig, like a coffee, it's all fine. It's like
Autocorrect.
we know what you mean. We know what you mean. It's all good. So it's all fun. All right. Okay. Lisa, you get to look at these. Go ahead and make your comments, and then Dory. And if there's anything left, I'll do cleanup at the end.
So I'm not actually surprised by this. Monitor and manage risks carefully, accept various risks, but monitor and adjust expectations. That's really been in line with a lot of the organizations that I've been working with. Is mitigate the risk. Making sure that in an environment of instability to try to stabilize that exposure as much as possible. So this doesn't surprise me at all. I'm curious. For the 11% that's actually trying to hedge to make money at times, what type of risk appetite that organization has, because that seems a little bit outside of what I've been seeing in the organizations that I've been working with.
I was going to say the same thing, Lisa. I'm glad that one fell last, because
Yeah.
if that's your gamble, you must have one heck of a portfolio. But I think I'm in line with what you said. This is exactly what I expected. I did think that the interest rate one at the top would get a little bit more, in particular with trying to plan around that current portion of long-term debt that we talked about that's coming due here, but also on, are they doing one? Are they doing two? Or do we manage this internally with swaps? Do we hedge interest rates? Given what's going on, what's the impact of a prolonged government shutdown, if it goes that far? What's the impact there on 10-year and US treasuries and stuff like that? So there's a lot to think about on the interest rate front, in addition, obviously, to FX, but interest rates are going to be pretty key over the next month or so if this gets to be a long shutdown.
Interesting. A couple thoughts I had on this. So the hedge to make money at times. I mean, if you're a firm that's a hedge fund, you hedge to make money at times. But I think what this means, I think sometimes people could answer this because you have something that's in the money, you're feeling comfortable, you pull it off, so you hedge or de-hedge at different times to do that. So it depends. Hopefully, we're not saying, "Hey, I can make money, make treasury or profit center if I'm just putting on hedges that are uncovered." Right? You have to operate within your envelope of tenor, size, what your objectives are. It's never to a particular percent, but you can move up and down. The hedge to bring our exposures in line with our risk appetite. For organizations that hedge, that's almost all corporates, right? You want to make sure you're reducing your risk so it fits within what you're willing to tolerate. Others accept the risk and say, "Hey, we're in this business of insurance, steel, whatever. We'll take those risks. We don't need to do another hedge." And the last one was that I wanted to say, I believe hedging adds cost to our business process, and we never or rarely hedge. Right? There's it's like, do you buy insurance? If everything was exactly equal, why would you buy insurance? Well, you want to protect against a catastrophic loss or something outside. There are costs to it, but consistency matters. Consistency matters in my financial performance. It matters. It matters in a number of areas that allows us to put on that type of insurance. We don't want something catastrophic, and we want stability. Just like when there's changing tariffs, it's radical. It changes every couple of days. It's businesses like things stable. They care what it is to some extent, but they really want stability and consistent stability. So I did like the number one, monitor and manage risk carefully. I think that's a good sign. I wish that number was higher, but that's one of the most encouraging parts of this, I think.
Yeah, 46%.
Yeah, that's good. And thank you. So I'm told we need 8 more Kyribas in the box to share that, but so we're almost there. All right, so handling inventory. Lisa, why don't you start us off with that? I mean, especially you that being from Detroit, the two of you, you're probably more tuned into the auto market than other jurisdictions or areas. But why don't you start us off on this one?
We're definitely impacted here in Detroit, and we kind of touched on this a little bit, briefly earlier when we're talking about the need for Treasury to really work in collaboration with the supply chain teams and procurement to address some of these inventory management strategies, and really how tariffs and this continued economic uncertainty is really impacting those strategies. So if we kind of take a step back, I feel like we've kind of seen a shift in how inventory is being managed. So traditionally, especially here in Michigan, think 8, maybe 10 years ago, so pre-COVID, many organizations were relying on the just-in-time approach, right? Let's maintain minimal inventory, ordering only as needed, because that's what's going to help us minimize storage and holding costs. And that approach works amazing in stable environments when you have reliable suppliers and reliable logistics. But as we've seen recent trade disruptions, this influx of tariffs, as we've been talking about, it's really kind of exposed the vulnerability of that model, where you might have a sudden supplier delay or this sudden tariff hike. It could really create some operational risk. So what we've been seeing now is a shift from just in time to just in case. And so this really involves maintaining a little bit of a higher inventory level in order to shield and prevent some of those shortages, particularly when supply chains are unpredictable. Some of these elongated lead times that we've been seeing. Back in COVID, we had the ships that were kind of stuck off of the offshore, and they were not actually able to bring the goods into the country. So this just in case theory and methodology, it helps to provide a buffer against some of those disruptions. But I think the more important aspect of this is it does come with higher carrying costs. You have working capital that's now being tied up in greater inventories. And so from a treasury and finance perspective, that's really adding to the pressure on those teams that are responsible for liquidity management. And so what we've seen even further as the continued uncertainty is really going forward, and as we're seeing the potential for additional tariff costs, is even a further refinement of the just in case. And I think, Craig, you mentioned it earlier, to more of a, we'll call it just before tariffs, where companies are deliberately purchasing stock right before an expected demand hike or expected tariff increase. And that's helping organizations to hedge against the rising costs, and allowing or helping to aid organizations kind of balance that inventory risk with optimal cash flow, by trying to time these purchases carefully. But I think what we're even seeing in Dory, I know you mentioned it, the organizations were kind of able to pass along the costs down to the consumer a little bit, or I'm sorry, they were trying to hold on to and absorb those costs. But now we're kind of starting to see that trickle effect of passing it on to the consumer. And I think that is kind of indicative of these, I'll call it just before inventory balances and inventory stock up. They're starting to dwindle. So now we're finally seeing some of the impact of the tariffs kind of feeding in through the inventory, as I'll call it just before inventory stockpile, if you will, it is dwindling. So I think kind of overall, it's really the way that we're seeing inventory shifting is really a kind of a reflection of this broader theme that we're talking about, where companies need to make sure that they're agile, that they're collaborative in their inventory management, and they really need treasury, procurement, supply chains. They all need that integrated data and data integrity to be able to leverage that in some of their forecasting models to see and effectively kind of alter some of these inventory strategies to really make sure that they're optimizing their working capital under some of these fluctuating conditions.
I think it's fantastic that we're on a strategic treasurer webinar and we're talking about inventory. The reason I think it's fantastic, the reason I think it's fantastic is because working capital is a four-legged stool: cash, payables, receivables, and inventory. And the fact that we're talking about it on a strategic treasurer webinar, as I said earlier, tells me that the treasurer is finally having a seat at the table with the company when these things are being talked about. historically, the treasurer had a seat at the table when when they're talking about risk, when they're talking about M&A, when they're talking about uh, any sort of divestitures or anything like that, needing to go into new regions to add new bank relationships, so on and so forth. But if the treasurer is in the room when they're talking about inventory, that's a very good strategic company because the treasurer needs to be aware of that information. They need to be aware because it's going to help them manage other areas of cash flow, right? When you have too much inventory, obviously that stresses cash. And if it's stressing cash, then the treasurer has to make other decisions when it comes to that area of the business. So I think it's great that we're having this conversation, and that to Lisa's point, it's increasing the value of the treasurer in the company, and it's adding to the need for having the right tool set to provide that level of visibility so that those insights are shared and modeled out all in a single source of truth that shows the impact on cash conversion or the impact on any M&A activity or any divestiture scenarios, or if you have a supplier that's stranded or not going to do business anymore because of tariffs or whatever, right? Having the treasurer at the seat of the table to talk about those conversations is critical. And I'm glad that we're here talking about inventory, like I said, because usually that's not topic du jour for treasurers.
Well, we're glad you're here talking about it with us. This is fun. Excellent.
Yeah.
Nice job, both of you, on talking through the inventory. That brings us to our third and final poll question. This one is another all that apply. Which external factor do you see as the biggest driver of your organization's operational or growth strategy over the next 12 months? We go from tariff changes down to geopolitical risk, and then the other catch-all other or unsure. So go ahead and fill those out, and we will go from there. Everyone who's active in the chat box, enough. Thank you so much. Appreciate that. That is excellent. So we'll let everybody answer the polls and quizzes. And Brian, if you want to pop in our LinkedIn invites, if Lisa and Dory, if you're interested in having people connect with you on LinkedIn, Brian can pop those in and we can do it. We have enough Kyribas in the box. There's no extra credit provided. And I see some people have typed in a second time. So no harm, no foul, but feel free to connect with me, Lisa, and Dory if you're interested. Did you nod? I guess you did, and I was looking elsewhere.
Happy to connect.
Okay.
Always good to have a good network.
It's a good way to connect and keep the conversation and keep in contact separately. So this is very fun. All right. Then we're in our final stretch after this discussion. We've got
But you got another great question here, man. Like I love these. I want to see what they say now.
people say you can't ask really complex questions in surveys, or certainly not in polls. Well, maybe you can't, but we're just doing it anyway. If we can talk about inventory, we can have hard questions, right?
There we go.
All right. Number one is interest rate environment is the biggest external factor. Number two is tariff changes. Three is geopolitical risk. Global supply chain shifts is next with 30%. And then currency fluctuations, fairly muted at 21%. So 1 out of 5 to 1 out of 2 in this mix. Who would like to go first with any comments on this?
One of the things that I think is interesting is that only 21% think that, not that they think the world is just humming along, but aren't really sure. I find that interesting because, like I said, we talk to companies all the time, and these topics, all of them, depends on the company, of course, are top of mind in terms of what they're looking at, why they're looking to invest in technology now, as an example, so that they have better insights in these areas. So the 21% is surprising to me. I would have thought that would be less than 10, if even 10. So that's surprising to me.
I think it's interesting to see that 49% are saying that the interest rate environment is going to be one of the biggest drivers. And yet on the previous poll question, they indicated that we're really not hedging or managing any interest rate exposure risk. So it's curious to me that we think it's going to be a big driver, and yet, you know, we're kind of just taking on that risk and not really necessarily managing it. So
It may be a big driver in reducing costs, especially if we're talking
Cost.
50 basis points, right? Over the next, or maybe more, right? Over the next, that's a good chunk of change on overhead costs, right? When it comes to interest rates. Yeah. What do you think, Mr. Craig?
I That's such a Southern way to say it. It's you can call me Craig or Mr. whatever works, but I think this is hilarious. But you know, that idea that if interest rates are pushing down, that does allow for a more affordable expansion. That makes expansion efforts more affordable, like the both of you had mentioned. So I guess that makes a lot of sense because tariff changes don't impact every company at a major level, might be moderate. Like we saw that curve. If you're on that top end, what was it like? Was it 16%? If you're in there, you probably put tariff changes if that was a major impact. But as you move down, interest rates could have a bigger impact, and then global supply chain shifts. Right? If I'm near sourcing or bringing manufacturing back to, let's say, if U.S. is your home country, that could fit. And then geopolitical risks sitting at there is number two because we see how big they are. Yeah, this just gives a lot of things to think about. I don't know if I said anything of value there, but I
I
can see
wonder
why.
if we weren't on a pending government shutdown, the geopolitical would have been as high as it is right now.
Yeah, I guess the second on that too is I don't see that going on for very long because I've never seen when the one political party is pushing for a shutdown and there's some kind of clean bill. I never see that really last too long because they get a lot of feedback.
Yeah, a lot of angry constituents.
I called it feedback.
Yeah.
Like, why is it being shut down? And it's anyway, so we'll see how that works out. But usually those things don't last very long because that's not a strong position. We've seen that time and time again. Anyway, we'll see how that goes. That would be, I guess we could have had that in the mix as well. Put the government shutdown, partial government shutdown to be more accurate, in one of the feedback items if it's not part of the geopolitical risk. So there's quite a bit here. This is getting to the how do we gain confidence? How do we respond more readily, be more adaptable? And let's go Dory and Lisa again. That seems to be our favorite flow.
Yeah, honestly, you're only as good as the tools you have. But that's really the point, and the same thing as we talked about that we're going to talk about later on in the years about AI. You're only as good as the tools that you have because of the need for data and the need for insights to be reliable, timely, on my desk yesterday, not today. And a lot of the challenges, if you don't have the right tools, is making sure that data is rationalized and visualized in the right way. Your CFO is not going to look at a spreadsheet, okay? They want a chart that tells them the story, and if they need to, they'll look at the spreadsheet. Obviously, it depends on your CFO. There are some of them that can nerd out on a spreadsheet better than the best of us. But for the most part, they're looking at dashboards and data visualization, and that's what they want to make decisions on. This picture tells 1,000 stories, right? 1,000 words or whatever that saying is. But regardless, so you're only as good as the tools that you have, and the tools that you have to give that capability for decisions to be made in that time frame that the board, that your CEO, that your CFO is looking to make. And I know, Lisa, you've done quite a bit of work in this area for us here at Kyriba, and I know you have a lot of good anecdotes to talk about when it comes to this.
I do. Well, one of the things you keep saying the tools, and one of the I saw earlier today that today is the 40th anniversary of Excel. So congratulations for all of you that are out there utilizing Excel. You're utilizing a 40-year-old tool to try to help to navigate all of this uncertainty and your data consolidation. So I think that kind of goes to show, a lot of kind of the lagging behind it on the treasury teams. Right now we're talking about AI and we're talking about automation, and yet within the treasury world, there are numerous organizations that I am talking to that are still managing all of their cash flow forecasting and liquidity planning, and even some of the hedging strategies all still being managed in Excel, which is now 40 years old. So I think a lot of what organizations are looking for is to kind of bring treasury into 2025 and really arm the team with the tools that they need to get them out of, I'll call it, out of the weeds and out of more of the tactical, and really being able to leverage the human capital that you have in your workforce to be able to be more strategic, to be able to provide some more of those strategic insights to the C-suite, to the CFO, and to Dory's point, don't provide tomorrow, provide it today as is, and have the ability to model all of these various scenarios in real time as things are constantly changing.
The story about data telling the story is very true, in particular with the liquidity benchmarking that we do here at Kyriba. And what we do is we compare companies who have the right solution versus companies who do not, when it comes to cash conversion, as well as any other interest coverage ratio, current ratio, quick ratio, all those ratios. You can clearly tell the difference from companies who are strategically managing their liquidity and the impact they have had over a 5-year period than companies who do not. I think we identified that the average cash conversion acceleration is about 5.8 days quicker for companies that leverage the right solution versus companies that do not in terms of the right technology.
Excellent. So that brings us to, we're going to be stepping quickly on the final thoughts, predetermined by coin flip, Dory, Lisa, and Craig.
Final thoughts is that instability is here for now. It's definitely gotten a little bit better since COVID. Okay, it's not as crazy as the COVID times. Obviously, we're all locked up in our homes. But there's a lot more happening that has the potential for impact when it comes to our ability to make sure that liquidity is managed the right way, currencies are managed the right way, and cash flow is managed the best optimal way for the protection of your company's assets and your company's balance sheet and your company's P&L. That should still be top of mind until we are in a situation where we can say, I know how to plan for next year, or I know how to plan for the next 2 years. I don't think a lot of companies can say that right now. And that's the part that I think we need to pay very close attention to, and making sure that we stay on top of as we continue to navigate in the areas that we discussed on cash flow, interest, currency, working capital, all the above, inventory.
Yeah. And just to add to that, if we're taking a look at the slide here, I would almost kind of switch these, because I think that the core is your data, right? We need to be able to ensure, where are we getting our data? Is it, how are we rationalizing our data? How are we cleansing our data? And to ensure that we have that data integrity. Once you have that data strategy, that's when you can start to layer on top your AI or your technology strategy, because the data is really what your AI is going to be learning from. So, ensure that you have a solid data strategy. That's when then you can layer on AI to give you to turn that data into actual actionable insights, and allowing you to be a little bit more strategic and proactive in managing and mitigating some of these risk and uncertainty that we've been talking about today.
Thanks, Dory and Lisa. So on the mindset, the ability to have two minds. One is analytical, see the relationships, leverage data and technology. Also on the risk management mindset, see how that impacts the crucial elements of your business. We'll let you read the slides later. Thank you for joining. I'll turn it back over to Brian. It was a few quick announcements. Thank you, Lisa and Dory.
Thank you.
And thank you everyone for joining us today. The CTP and FP&A credits, today's webinar slides, and a recording of today's webinar will be sent to you within 5 business days. And for more on all things Treasury, be sure to check out the Treasury Update podcast by clicking the link in the chat box. Thank you, and we hope you have a good rest of the day.